What would you do if you found yourself sitting on $100,000? How do you actually make a fortune off of it that could truly secure your future? You see, having 100K is exciting, but it's also the point where the game truly begins. In fact, this is where most people make critical decisions that will either catapult them into financial freedom or become just another notch on the belt of missed opportunities. I'm going to explain 10 strategies based on Buffett's wisdom that will quickly multiply your 100K into great wealth. You need to know all 10 techniques if you want to build a fortune that actually lasts for generations. So stay with me and follow closely until the end. Number 1, educate yourself. As you might already know, Buffett once said, "The best investment you can make is in yourself." Now, let me make this clear. This doesn't necessarily mean going to the gym or learning how to cook. It boils down to understanding how money works, how the markets operate, and how you can leverage this knowledge to make smarter decisions. Think of it this way. You wouldn't start constructing a house if you don't know how to set up a foundation, would you? So, why would you try to build wealth without understanding the basics of investing? Now, let's say you just took 2% of your 100K. Yes, that's $2,000, plus bought the book like The Intelligent Investor by Benjamin Graham, which also happens to be Buffett's favorite, or you took a course on value investing. Assuming the lessons you learn here help you achieve 5% annual return on your investments instead of 2%, you'll end up making $3,000 more on your 100K. And in case you needed more proof of this, you should know that Buffett himself spends about 80% of his day reading and learning. The truth is, the more you know, the better decisions you'll make. After all, failing to invest in your own financial education could cost you far more in the long run than any upfront costs you might incur right now. Number 2, pay down high-interest debts. Okay, so let me get this straight. Many people stumble when they have 100K saved up because they say, "I'm already rich. I can afford to take a little debt." But as a quick reminder, Buffett said, "The chains of habit are too light to be felt until they are too heavy to be broken." Here's the thing, high interest debt is toxic. Let's do some quick math to explain. Imagine you have $10,000 in credit card debt with an interest rate of 20%, which is not uncommon. If you make only the minimum payments, you could end up paying over $12,000 in interest alone over the years. We're talking about more than double the original debt. Meanwhile, your 100K is just sitting, losing value due to inflation, which I'll explain later. The best thing you can do for yourself at this point is take a portion of that 100K and wipe out any high-interest debt you have. Once that liability is gone, you're now free to invest and start growing true wealth without debt weighing you down. You don't really have to buy your credit card company a new yacht this year. Get yourself one instead. Number 3, set up an emergency fund. You're debt-free. You've started educating yourself, and now you're feeling pretty good about your financial future. So what's next? Well, Warren Buffett once said, "Predicting rain doesn't count, building arks does." In other words, you need a safety net, an emergency fund that can cover 6 to 12 months of expenses. To draw a much clearer picture, let's say your monthly expenses are $3,000. To cover 6 to 12 months, you'd need to set aside $18,000 to $36,000 in a high-yield savings account. Now, here's where things get interesting. The purpose of this fund isn't to grow your wealth, it's to protect it. You see, having an emergency fund means you won't have to sell off investments or go into debt if something unexpected happens. Here's the thing, the concept of an emergency fund might seem simple, but it's one of the most overlooked aspects of personal finance. People get so caught up in the idea of investing that when the unexpected happens, they're caught off guard. If you don't have an emergency fund, you could be forced to sell your investments at a loss. Or worse, take out a loan to cover unexpected expenses. But looking at the bigger picture, an emergency fund gives you the confidence to invest more aggressively elsewhere, knowing that you're covered in case things go south. Number 4, keep it simple and invest in things you understand. Now, Warren Buffett famously said, "Never invest in a business you cannot understand." I think we can all agree that investing in cryptocurrencies, biotech startups, or derivatives sounds good, but here's the thing. If you can't explain the details of what it's all about, maybe it's not the best idea. If you know how to care for an apple tree, plant apples. You don't want to grow pears because you don't know how they work. Let's say you're considering investing in a tech startup that's developing quantum computing technology. Sounds exciting at first, but what if you don't understand how quantum computing works? How can you possibly assess the risks and rewards? As it turns out, keeping it simple can lead to better results. Buffett himself has made billions by investing in companies with simple and straightforward business models like Coca-Cola, Apple, and American Express. And in case you needed more proof of this, you should know that one of Buffett's most famous investments is in Sea Candies, a company that makes candy. No frills, no complex algorithms, just good old-fashioned chocolate. So, focus on investments that you can wrap your head around. Index funds, blue chip stocks, or real estate. These are the kind of investments that have stood the test of time. In other words, keep it simple. Number 5. Spread your risk, but don't overdo it. Okay, now that you've got your 100K invested in what you understand, what's next? Well, as most of you already know, putting all of your eggs into one basket can be risky. Buffett once said, diversification is protection against ignorance. It makes little sense if you know what you're doing. So, what does this mean for you? You see, diversification is all about spreading your risk, investing it in a variety of assets so that if one fails, you don't lose everything. But that's not the only interesting part about it. Buffett's points is that while diversification is essential, overdoing it can dilute your returns. In other words, you don't need to own 100 different stocks to be safe. A well-chosen handful can do the job just fine. You want to diversify enough to spread your risk, but not so much that you're spreading yourself too thin. And surprise, surprise, this is where many investors go wrong. They think more is better. But as it turns out, too much diversification can lead to average returns. Let's break this down further. You might consider allocating 40% of your 100K into index funds, 30% to individual stocks that you thoroughly understand, 20% to bonds for stability, and 10% to real estate or other alternative investments. The last thing you want to end up with is a portfolio that's so scattered that it becomes impossible to manage. This is all about quality, not quantity. Number 6. Focus on long-term value. Now that you've got a well-balanced portfolio, what's the thing you need to be cautious about? Well, most of you already know the stock market can be a roller coaster. But what's even more distressing is that many people can get caught up in speculating the market, trying to time the market or bet on that next big thing. Warren Buffett said, the stock market is designed to transfer money from the active to the patient. In other words, those who jump in and out of the market trying to make a quick buck often end up losing money to those who take a long-term approach. Sure, you may get lucky once or twice off speculating in the market, but over the long haul, the odds are against you. And in case you're not aware, studies have shown that active traders often underperform the market by a significant margin. The truth is, you should focus on long-term value. This means investing in companies or assets that have strong fundamentals, good management, and a history of steady growth. Buffett didn't build his fortune off betting on penny stocks or speculating in the market. He invested in solid companies and held onto them for years, even decades. Assume you've invested $10,000 in a value stock that grows at an average rate of 7% per year. After 10 years, that investment will have nearly doubled to $19,672. Now let's say you're trying to time the market. You'll more likely end up with lots of stress and a lot less money than if you just stayed the course. On top of this, the emotional toll of trying to predict the market movements can lead to poor decision making. So, focus on finding and holding quality investments for the long haul. Because when you take a patient, value-driven approach, you're more likely to see your 100K grow steadily over time, without the stress and uncertainty that comes with speculative trading. Number 7. Reinvest your earnings. Now, Warren Buffett once said, My wealth has come from a combination of living in America, some lucky genes, and compound interest. So what's even more fascinating is how compounding can turn your 100K into a massive sum over time. Compound interest is like a hot spring that never runs out. When you reinvest your earnings, whether they come from dividends, interest, or capital gains, those earnings start earning money too. Over time, the effects of compounding can be astronomical. Let's break it down. Suppose you invest $100,000 with an average annual return of 7%, but you reinvest all your earnings. In 10 years, your investment would grow to about $196,715. But if you let it compound for 20 years, you're looking at around $386,000. And if you keep going for over 30 years, you'll have an incredible $761,000. Many people underestimate the power of compounding because they don't see immediate dramatic results. It's a slow burn at first, but as time goes on, the growth becomes exponential. So always reinvest your earnings. Whether it's dividends from stocks, interest from bonds, or gains from real estate, put the money back to work. Because as it turns out, this is one of the most effective ways to turn your $100,000 into true wealth over the long haul. Number 8. Keep cash ready for opportunities. You're on your way to building wealth, but here's where things start getting exciting. Buffett once said, "Cash combined with courage in a time of crisis is priceless." And this is the advice you should take to heart. While it is crucial to invest wisely, it's equally important to stay liquid. That means keeping some cash readily available for times such as when the stock market takes a dip and presents a buying opportunity. Here's the thing, if all your money is tied up in long-term investments, you might find yourself in a tough spot when a golden opportunity comes along. Warren Buffett's Berkshire Hathaway is famous for holding large amounts of cash on its balance sheet. Why? Because Buffett knows that being able to act quickly when the time is right can make all the difference. But what's even more distressing is that many people overlook the importance of liquidity. They invest everything they have, only to end up missing out on great opportunities to buy more. Assume you have $100,000 invested, and when the market suddenly drops by 20%, if you've got some cash ready, you can buy more at a lower price, setting yourself up for greater returns when the market recovers. So keep some cash, maybe 10 to 20% of your portfolio, in a high-yield savings account or a money market fund. This way, you're prepared for whatever comes your way. Number 9. Don't inflate your lifestyle. You're now building wealth, but how do you actually get to keep it? Well, as most of you might already know, lifestyle inflation is a huge problem. Buffett warns, if you buy things you do not need, soon you will have to sell things you need. You see, it's easy to get carried away once you start earning more. A nicer car, a bigger house, luxury vacations, it all sounds awesome. But if you let your spending increase every time your income does, you'll find yourself running but not moving. But what's even more worrying is that many people end up spending so much on luxuries that they have to dip into their investments to cover their expenses. And in case you're not aware, this can seriously derail your wealth building efforts. I think we can all agree that selling off your assets just to maintain a lavish lifestyle is a recipe for financial disaster. To draw a much clearer picture, consider Buffett himself. Despite being one of the wealthiest people in the world, he lives in the same modest house in Omaha that he bought in 1958. But what I'm going to reveal next is perhaps the most interesting part. Keeping your lifestyle modest doesn't mean you have to live like a monk. Instead, just be mindful of your spending. And you might be surprised to find that living a simple life brings more satisfaction and true happiness. The truth is that many people who earn a lot end up with nothing because they spend everything. Don't be one of them. Live below your means as you look to not only preserve wealth, but also multiply it. Number 10, plan your estate. Now that you've worked hard and made a fortune, what happens when it's time to pass on your wealth? Well, as most of you already know, estate planning is one of the most important and often neglected aspects of wealth management. Without a solid estate plan, your hard-earned wealth could end up in the wrong hands, or worse, become the subject of family disputes. Someone is sitting in the shade today because someone planted a tree a long time ago. Let me explain. Estate planning doesn't mean just writing a will. It's about ensuring that your assets are distributed according to your wishes and providing for your loved ones in a way you truly intend. In reality, your estate could be subject to significant taxes and legal fees, reducing the amount your heirs actually get. And in case you're not aware, this can be especially problematic if you have a complex financial situation, like owning a business or multiple properties. You might want to consult with an estate planning attorney who can help you navigate the complexities of trusts and tax planning. You have spent your life building a financial legacy, so don't let it slip away. It's time to take action. Don't sit on your savings. Make your money work for you. Educate yourself, invest wisely, and most importantly, stay the course. And with Buffett's wisdom as your guide, you're already miles ahead of the competition. But if you don't have $100,000 saved up, click the video on your screen to find out how to save $100K in 3 years or less.